Thanks for clicking. Canada's banking regulator is getting increasingly worried about the amount of debt held by Canadians. This according to an interview with Peter Routledge, head of the Office of the Superintendent for Financial Institutions, or OSFI.
Welcome to the club!
The interview with Routledge came as OSFI announced some changes to Canada's mortgage market, tweaking the rules for home equity lines of credit and for reverse mortgages. While these rule changes are relatively minor, and some saying that OSFI should have gone a lot further, they nonetheless represent further moves by the government to crack down on Canada's HELOC usage. Given that Canadians are increasing their home line use at record pace, the changes should help nonetheless. So what I want to do today is go over the rule changes announced by OSFI, discuss the interview held with Peter Routledge, and then go over what to look for next. Speaking of next, we're expecting to get June's data out from the local real estate boards over the next few days, which will obviously give us a good idea of where Canada's real estate market is heading. We'll obviously have updates out on that data on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, let's get into these rule changes. The first and most dramatic change being made by OSFI concerns home equity lines of credit, or HELOCs. Under the current rules, the home equity line of credit portion of your house cannot exceed 65% of your home's value, and it, combined with the mortgage on your house, cannot exceed 80% of your home's value. So, under the current rules, if your house is worth $100,000 and your mortgage is $80,000, for every $1,000 you pay down of that mortgage, you get an extra $1,000 available on your home equity line of credit. You then have the option of making interest-only payments on that home line.
Not an option.
However, with the new rules announced yesterday by OSFI coming into effect in late 2023, any amount held on your home equity line of credit that is over and above 65% of the home's value will have to be paid down before you'll be able to take out any more money. So, on that scenario that we looked at earlier, say your house is worth $100,000 and you have a mortgage of $65,000 and a HELOC of $15,000. You will have to make principal and interest payments on that HELOC until the total loan is under $65,000 before you can access any more money on that home equity line of credit. So under these new rules, Canadians will still have their home equity lines of credit, but the rules are tightening marginally. The other changes announced by OSFI concern reverse mortgages. A reverse mortgage is where you borrow a certain amount of money, and instead of having to make monthly payments, those payments get tacked on to the principal amount owed.
Difference gets tacked on to the principal.
So say if you borrowed $100,000 and under normal circumstances, a normal mortgage, you would pay $500 a month. After the 1 month on your house, you would owe $100,500. After the second month, you would owe $101,000, etc., etc. The idea is behind a reverse mortgage, once the home is sold, then the lender gets all of their money, their initial advance, plus all the payments that they weren't getting throughout the life of the loan.
You know that.
Under the new rules from OSFI, they are setting a maximum amount that can be advanced to on a reverse mortgage to 65% of the home's value. Now, most reverse mortgage lenders were already doing this anyway, but now it's been mandated by the government that they can't advance any more than 65% of the appraised value of your home. These changes are relatively minor and aren't going to affect the mortgage market in any significant manner anytime soon.
Then why are you telling people?
But I do think they show a banking regulator that is getting increasingly worried about the amount of debts that have been taken on by Canadians. The HELOC portion of our total mortgage debt is around $200 billion, which is only about 10% of $1.8 trillion total mortgage debt held by Canadians, but significant nonetheless, and definitely significant enough to garner the attention of OSFI. And Peter Routledge said as much when he had his interview with Bloomberg yesterday following the release of OSFI's new rules.
If you're asking, are you worried as rates continue to rise, will it put stress on Canadian households? Yeah, we're very worried about that. And we're constantly looking at what we can do to add a bit more resilience into the system.
Though Canadians, at least right now, have a relatively low delinquency rate on their mortgage payments, with over 99% of borrowers being up to date and in good standing on their mortgages, OSFI wants to keep it this way. And I think they're following a trend that we've started to see from the regulators, from the Bank of Canada, from the government, getting more and more worried about our house prices.
Took you long enough.
As house prices continue to fall in Canada, as we've seen over the past few months and are likely to continue to see over the months ahead, I think the government, which announced about a month ago a major change to its shared equity program, and the Bank of Canada, and now OSFI, are getting worried that Canadians and the government, to a certain extent, are going to be underwater. They don't want to see more money owed on these homes than the homes are actually worth. So I think that when we see within a period of a few months, OSFI, the Government of Canada, and the Bank of Canada coming down warning about home values and changing their policies vis-a-vis those home values and the amount that you can borrow against them, it's not a great sign for real estate values going forward. And we're likely to see more changes as the values of Canada's real estate market continue to drop. We will have updates out on those values on this channel and any changes made by the regulators and by the government. If you want to get those updates, make sure you click like and subscribe, and thanks so much for watching.